Okay, welcome back to Financial Accounting at 5. In this video, we want to look at a question on insurance claim, and this question is of November 2023 question paper. So this is question 4, and the question reads, Mr. Fongo's business sales at a profit markup of 55%. Um, so the markup that we have there is 55% on cost price during 23 December 2020. A fire destroyed all the inventory except inventory to the value of 18,700 rands. His inventory was insured for 110,000 rands, and the average clause was applicable. Very important to take note. And then Mr. Fongo accounting records showed the following on 23 December 2020. Inventory on 1 January 2020 was 43,700 rands, which means this is going to be your opening inventory. Purchase amounted to 162,000 rands. The sales amount was 195,600 rands. The cost for import duties and freight amounted to 6,700 rands and 8,500 rands respectively. The purchases retained that were supplied were 32,000 rands, while the sales retained was 6,310 rands. The business had a sale of inventory during October 2020, where inventory to the value of 42,300 rands sold at the market price less 25%, which was included in the amount of the total sales. So this is the information that we have. So if you go down, you'd see that the question now reads, Mr. Fongo requested you to calculate a claim submitted to the Sanlam Insurance Company where the average clause was applicable. Show all the workings calculations or the calculations, and our question has got 26 marks. So this is what we have, guys, in terms of this question. But before you answer the question, let's try to break down the formulas that we are going to use for the insurance claim. So what we are saying to show this insurance claim, we are going to use the formula. The formula that we are going to start to use is we are going to say to calculate inventory loss. So the formula for inventory loss, we are going to say it is equal to our inventory minus the salvage amount. And you will see that the salvage amount that we have in the question, you can just refer back there. The salvage amount, if you come here, you would see that there is an amount that we are given that is representing our salvage amount. 18,700 rands becomes our salvage. Remember, this is the inventory. They are saying a fire destroyed all the inventory except inventory to the value of 18,700. So it means this is going to be your salvage. So the remaining inventory. So this is what we have in terms of salvage. And then if you see in this calculation also, we have got the issue of inventory. So the inventory that we are going to consider at this point of calculating inventory loss is going to be your closing inventory. So, but if you come here, you would see that we are not given the closing inventory in the information that we are given. We are going to find the inventory amount by preparing the trading account, whereby it will be a missing figure. So first of all, we would have to find the gross profit, the total gross profit, whereby we are going to say the normal sales. We are going to add the normal sales gross profit there, and the other gross profit that we are going to calculate there, and then we get the total gross profit that we are going to insert in the missing figures in the trading account as our gross profit. Then we can find our closing stock as a balancing figure. So this is what we are going to do. So you would see that this figure for inventory, we are going to find it as a balance figure in the trading account, whereby we are going to start by finding the gross profit there, and then we put it in the trading account, then we find our gross inventory as a balancing figure. So our gross profit also, you see that our gross profit also, we are going to say to find it by saying it will be equal to gross profit for normal sales, and then we are going to add also the gross profit for yield sale. So this is exactly what we are going to do. So firstly, we are going to try to input the figures in the trading account. If you come to our answer section, you'll see that we've got an already prepared trading account there. So we are going to put our figures in terms of what is supposed to be on the debit and what is supposed to be credit on the credit. Remember, purchases will also come to the debit side, sales will come to the credit side. But the information that we are going to put in the trading account, we are going to find it there in the question. If you come here, you would see that we are given that inventory 1 January 2020 was 43,700. So our 43,700 is our opening stock, which is supposed to come to the debit side. So if you come here, you see that this is the debit side. So that's where we're going to put our opening inventory. So we're going to say opening inventory, and it's 43,700. And this is what we have. And so we can try to see it on the figure of sales and purchases. Remember, purchases is going to come to the debit side. Let's start by purchases. So you see that purchases amounted to 162,000, but you see that there are returns that are there. That we are also told there that there are purchase returns here. The purchases are returned that were supplied were 32,000. So we are going to subtract 32,000 from the figure of 162,000 so that we get the net figure. So we come here. We are saying purchases, whereby we are saying in brackets 162,000. Then we subtract your 32,000. Then if you do that, you are going to get your 130,000. And obviously, we can also try to find the figure for sales. The figure for sales, remember, this sales figure that we are given is 195,600. It also have returns that are here, while the sales return was 6,310. So we are going to subtract 195,600 minus 6,310. So sales, remember, they come to the credit side of the trading account. So we are now saying 195,600 here. Then we subtract your 6,310. And then the amount that you are going to get there is going to be 189,290. And then obviously we are now checking the figure of import duties and freight on purchases. Remember, those figures we are given in the question. Remember, they increase the purchases. So we are saying freights amounted to 6,700 and 8,500 respectively. We have got import duties being 6,700, and then we've got freights being 8,500. So we are just going to enter them on the debit side again of that trading account. So if you come here now, we are saying our import duties. For import duties that you are given is 6,600. And then we have got the figure for freight on purchases. Which is 8,500. So what is going to happen here is we have entered all the elements that are supposed to be in the trading account. But you'd see that the figure that we are going to calculate there is gross profit, which is going to come here. Gross profit, which is the figure that we don't have. And when we find the gross profit, we're going to put it here. Then we can find now the closing stock, the closing inventory at this side also as a balancing figure. So this is what we are going to do. So we can just put our double lines. So we can only be able to fill the missing figures in terms of the double lines. The figure that is going to come in between the double lines after we've found the gross profit, we put it here. Then we can find our closing inventory as a balancing figure. So this is what we have. So we can go back there and try to find out in terms of that gross profit figure. So to find it, first we have to try to calculate our normal sales. So firstly, we calculate our normal sales figure. So what we are saying there, to find our normal sales figure, we are going to say the total sales that we are given, the total sales that we are given. Remember, there when we calculated sales, we subtracted our sales returns. We got 189,290. So this is the figure that we are going to use. So we come here, we are going to say 189,290. And then we are going to subtract the figure that we have here. Let's try to see. Let's try to see the figure for. So so if you come here, you would see that we've got a statement which is saying the business yet a sale of inventory during October 2020, where inventory to the value of 42,300 are sold at the market price less 25% there, which was included in the amount of total sales. So we've got an amount of 42,300, which is inside the 189,290 that we have here, which was sold below the market price, which means its markup is not in line with others, which are having a markup of 55%. This one was sold with a markup which is 55 minus 25. So we need to remove it from the figure that we have for 189,290. So we come here, we remove this for 2,300 to get our normal sales. So we subtract our 42,300, and obviously the figure that we are going to get there is 146,990. Then after getting this, so this is going to be our normal sales. So our normal sales are going to be this one. Then also we have got our yield sales. Our yield sales. So this 42,300 now represents the yield sales. So having these two figures now, we can now calculate the gross profit inside our normal sales, and then gross profit inside our yield sales. Then we add together to get the total gross profit. So if you come here, remember we are saying total gross profit is equal to gross profit for normal sales plus a gross profit for yield sales. So we are just going to use those ones, and let's take note. Let's take note that the figure that we are given there, it's the figure for selling price, which is going to be the selling price, sorry, the cost price plus the markup. So we are just going to calculate it as such. So let's try to see. So to calculate the gross profit for yield sales, we can start by here with yield sales. So to calculate its gross profit, we are going to say selling price minus our cost price. Our selling price minus our cost price, then you get your gross profit. Remember, the formula starts from cost price plus cost price plus gross profit. It gives us gross profit is the markup. Will give us our selling price. So if you make the gross profit sum of the formula there, it becomes your selling price minus your cost price. So this is the formula that we have there. But we are given the selling price is 42,300, but the cost price, we need to reduce it to make it a proportion of the market price, what it was supposed to be. Remember, we are having a markup of 55%. So we are going to convert it. Remember, this 42,300 is up. It's the price that is 25%. That was 25% less. So if you come here, you see that there's an explanation that is saying. Let's try to see. We have an explanation that's saying it was sold at 42,300 at the market price less 25%. So what we need to do is to go back to the market price and see exactly what amount we are supposed to use. So let's try to see. Let's try to see there. So what we are saying this 42,300 is 25% less. So we want to find the 100%. In other words, we are saying this 42,300 is 100% minus 25%. So we are saying it is equal to 75%. This 42,300 is equal to 75%. So the figure that we want is 100%. So what we are going to do is we are just going to say 100 is the figure that we want, is what we want, and then what the figure that we are given 42,300 is what we have. So 75% becomes the denominator. Then you multiply by 42,300 so that we find the market price. So if you find if you calculate there, let's try to see, you are going to get 56,000, 56,400. So here we've got 56,400. So after getting the market price, we can now calculate the cost price now. Remember, so we come here, we've got our market price is 56,400. So we can now calculate the cost price. So market price 56,400. So to calculate the cost price now, remember we can go back at the beginning of the question and see what they are saying. We've got a 55% on the cost price. So it means the figure that we have for market price is 100% for cost. Remember, if you say your cost price, you add your markup, which is your gross profit, you are going to get your selling price. So in this case, we have got cost price is always 100%, and then the markup that you are given is 55%, and it give you 155%. So in other words, we are saying this figure that we are given here, 56,400 is our 155%. So the figure that we are looking for is 100%. So it can just make a proportion whereby we're saying 155 is equals to 56,400. Then the figure that we want is 100%. So we can just make a proportion there by saying 100 over 155, and then you multiply by 56,400. Let's try to calculate as such. Let's try to calculate there. So if you calculate there, you'd see that you are going to get 36,387.10. So this is the profit for a yield sales. Sorry, this is the cost price for yield sales. So this is going to be the cost price. Then we are going to use that formula of saying to find now the gross profit. We are now saying selling price minus cost price. So our selling price, I remember, is 42,300. So if you come here, you'd see that this is our cost price. Our selling price, sorry, is 42,300. And now we have the selling price. So we can now find the gross profit. So we are saying now gross profit is equals to selling price, which is 42,300. Then you subtract your cost price that we found there is 36,387.10. So if you calculate correctly there, you are supposed to find 5,912.90. So this is your yield profit. So remember, where we want to arrive is where we are going to say now. Is where we are going to say gross profit for normal sales plus gross profit for yield sale. So now we have got gross profit for yield sale, which is our figure that we found there, which is 5,904.90. So we now want to find the figure for normal gross profit for normal sales. But already we have got the figure for normal sales that we calculated there. So we go there and just use that proportion again to find the gross profit on normal sales. Remember, normal sales, we are saying it's 146,000. Normal sales is here. We are saying it's 146,990. So we are saying 146,990 is equal to 155, like what we did on yield sales. So the figure that we want is 100%, be the cost price. So this is the missing figure. So to find it, we are going to say 100. What we don't have is 100 over what we have, which is 155 times the given figure, which is 146,990. And then you would see that the cost price now, which is 100%, will become there. If you calculate correctly, you're going to get, let's try to calculate as such to get your, okay, we can, when you calculate that, let's try to see what we get there. We say 100 divided by 155, and then we are going to multiply by 146,990. You'd see that the answer that you are going to get there is 94,832. 94,832. So here we are saying 94 94,832 .26 to the nearest two decimal places. And then after having the cost price now, so this is now representing our cost price. So to find the gross profit now, remember we are now saying selling price minus cost price. So what we are saying now, our gross profit is now equal to our selling prices 146,990, and then you subtract your 94,832.26. So let's try to calculate that one, whereby we are saying 146,990, and then you subtract your 94,832.26. And then you are going to get 52,157.74. So you're going to get your 52,157.74. So this is gross profit on normal sales. So to find the total gross profit now, we are going to add it to gross profit on yield sales. So we come here, we are saying now, we are now employing that formula whereby we are saying gross profit for normal sales plus gross profit for yield sales. So we are coming here, we are saying this one for yield sales, which is our 5,912.90, plus the one that we have for normal sales, which is now 52,957.74. So we add the two, you get the total gross profit, which is 58,070.64. Sorry, here we are saying 0.64. So we are saying 0.64. So this is our gross profit that we are going to put in the trading account. So we can take this figure and come to the trading account now. We are now saying our gross profit is 58,070.64. And then now, if you add, you see that debit is greater than the debit is greater than the credit. So if total for the debit now, including this 58,070.64, becomes 246,970.64. And then it's going to come both sides, 246,970.64. And then we subtract 189,290 to get the balance figure as our closing inventory. It becomes 57,680.64. So this is what we have in terms of our gross profit. So this is the figure for gross profit that we have. Then now to get our inventory loss, now we go back. Remember we said to get our inventory loss now, we are saying, if you come here, I think we had a formula that we put there for inventory loss, that we are saying to get inventory loss, we are saying inventory minus your salvage. So your inventory figure is the one that we found in the trading account, which is 57,680.64. Then we subtract your salvage. Your salvage, we said, we found it at the beginning of the question, whereby we are saying your salvage is, let's try to see. The figure for salvage, we have it there is 18,700. So what we are saying, we are taking the figure for our closing inventory, and then we subtract salvage. So if you come here, we are saying, let's try to see. So our closing inventory is 57,680.64, and then we subtract salvage 18,700. So here we are saying now for salvage, we are saying salvage. We are saying inventory loss. We are now calculating inventory loss. So we are saying inventory loss is equal to your closing inventory that we found there is, let's try to say it was 57,680.64. Then you subtract yourself and use 18,700. And then the answer that you are going to get there is 38,980.64. So this is going to be your inventory loss. Then obviously, now we also want to find the figure for, this is the figure for inventory loss. And then the figure that we also want is the average clause. The figure for average clause. Remember the formula that we use for average clause. The formula that we use for average clause, we are going to say average clause is equal to insured amount over closing inventory insured amount over closing inventory, or we are saying insured amount divided by your closing inventory, and then you multiply by the inventory loss. By the inventory loss over 1. So let's try to see. So this is the formula that we have for average clause. We are saying insured amount over our closing inventory, and then we multiply by your inventory loss over 1. So the insured amount, we are going to find it there in the question. Remember, if you go back to the question, we are given the insured amount. You'd see that let's try to go to the beginning of the question. We are saying that the inventory was insured for 110,000. So this is going to be your insured amount, 110,000. Then your closing inventory, we calculated it as 57,680.64 in the trading account. And then we multiply by the inventory loss. The inventory loss also, we calculated it down there. So we're just going to substitute those figures there. So if you come here now, we are now saying your insured amount, the insured amount that we have there, remember, it's 110,000. Then we divide it by the closing inventory figure that we are having in the trading account, which is 57,680.64. And then we multiply by the inventory loss. We multiply by the inventory loss. We can just refer back to see where we calculated the inventory loss, the actual figure. Inventory loss is here, which is 38,980.64. So we're going to calculate it here by multiplying it. So we are saying multiply by 38,908.64 over 1. Then if you calculate it correctly there, you are supposed to get, obviously, to 2 decimal places, 74,338.12. So 0.4 cents. So this is what we have in terms of the calculation of the calculation that we have there for average clause. And then also so the average clause that we have is 74,338.12. And then also, if you check there, we also found our inventory loss as 38,980.64. So this is what we have, guys, according to the requirements of the question. So if you go back to the question, you would see that that was exactly what the question was asking. The question is saying, Mr. Mskong will request you to calculate a claim to be submitted for the Sanlam Insurance Company where the average clause was applicable. Show all the workings are in calculation. So we've solved all the workings according to the requirements of the question. So thank you guys for listening. Those who have subscribed, please subscribe and share. We are still coming with more videos. As for this video, I'm signing out. We meet again in the next video.